Thank you very much, and again, good morning, ladies and gentlemen. So our panel today, as you well know, the COVID-19 pandemic has exacerbated social inequality across both developed and emerging market economies. So the panel will discuss how inclusive insurance can contribute to addressing inequality and promoting sustainable development. Topics in focus are obstacles to and opportunities for innovative solutions to increase inclusive insurance through technological innovation, public-private risk-sharing initiatives to address protection gaps, and possible changing product offerings to meet the needs of consumers post the pandemic world. The discussion will also consider the role of insurance supervisors in supporting inclusive insurance and examples of practical steps that can be taken to support more equitable and sustainable outcomes. And I'm very pleased to present to you my panelists this morning, two on stage and two virtually. So first of all, Hannah Grant on my left. She's the head of the Secretariat of the Access to Insurance Initiative. Then I've got Ileana Jelic. She's the Deputy President of our host Handvas Board. On the screen, I've got Thomas Soley, and Thomas, thank you for your dedication to be up 3 o'clock in the morning to participate. And Thomas is the chair of the IIS Financial Inclusion Forum, and he's also the General Superintendent of Insurance of Costa Rica. And then last but not least, who's up 5 o'clock in the morning, I believe, is Sherry Spiegel. She's the Chief of Policy Analysis and Development Financing for Sustainable Development Office at the Department of Economics and Social Affairs of the United Nations. So thank you very much for participating this morning. Before we actually start with the panel, I would like to give Thomas an opportunity as the chair of the IIS Financial Inclusion Forum just to give an update on the work of the FIF, including this year's focus. So Thomas, the mic is yours.
Thank you, Madam Chair. The panel is certainly in good hands. First of all, good morning to the audience and panelists. It is a great pleasure to be joining you today, virtually, but to discuss a topic I hold very close to my heart. Inclusion in insurance is key to addressing many social challenges and achieving the Sustainable Development Goals, of course. Before continuing, I would like to reflect one of the biggest social challenges we currently face, the ongoing geopolitical conflict and the harrowing impact on the population. This reminds us again of the need for a global effort to achieve a fairer and more equitable world. At its establishment, the FIF encountered a challenging environment due to the outbreak of COVID-19. In this context, the forum addressed pressing issues such as the impact of the pandemic on financial inclusion, digitalization, and consumer protection. We were also confronted with the emerging trends that fall within the scope of the SDGs, such as financial illiteracy, climate risk, and insurance roles in building future resilience. With this in mind, we shaped an ambitious work plan for this year. So far, we have discussed financial education's roles in increasing access to insurance, as well as data collection related to inclusive insurance and SDGs. For the second half of the 2022, I will have the pleasure of welcoming FIF members in Costa Rica for our first in-person meeting to discuss climate risk and protection gap and share a workshop on disaster preparedness. I am confident that this panel will be an excellent opportunity to discuss the role of insurance in pursuing the SDGs and hear the views of the broader IIS membership and the stakeholders. With this in mind, I hand back to you, Suzette, and thank you.
Thank you very much, Thomas, for the update. So we've decided to do the panel in sort of 4 rounds. In each round we will tackle a specific topic or theme for the panel discussion. And also as part of the panels, we also have some polling questions for each of the rounds. So if they can put up the questions for you as the audience to answer while we start with the panel discussion. And the question, is the question up? Well, I guess it will come up just shortly, but just to say that the question is, what is the main challenge for making insurance markets more inclusive? So the audience can, whilst we go through the responses, then answer that question. So the first theme is challenges to inclusion in insurance. And I'm going to start off with you, Anna, with a question. So the I2II has a long-standing and fruitful cooperation and relationship with the IIS in advocating for and supporting financial inclusion. Two of the many outcomes of this cooperation is the application paper on regulation and supervision supporting inclusive insurance markets, as well as the application paper on the use of digital technology in insurance. So, for you, what are some of the key takeaways from these publications which EMDE supervisors could leverage to overcome the hurdles and advance inclusion in insurance?
Thank you, Suzette, and good morning, everybody, and dobro jutro. I'm delighted to be here, not just because the panel is taking place at quite a sociable 11 a.m. as opposed to 3 and 5, but also because Dubrovnik is a beautiful city, so it's a real pleasure to be able to see it in person. So apologies also for both Thomas and the other panelists for not being able to be here. But sorry, going to your question, for me, and the main takeaway for supervisors is that you need to think differently. So if you want to really support financial inclusion in your jurisdiction, you need to act in a different way. It's not the same as just supervising general insurance. Instead, you need to think who the underserved consumers are in your jurisdiction. You need to think what their characteristics are, where they live, what their needs are, what the risks are they face. And then you need to think about, well, how does your regulation and supervision support these sort of people getting access to insurance? And as described actually in quite a bit of detail in both the applications paper, the typical underserved and excluded consumer has a low level of formal education, has low trust in formal financial institutions, probably has a low income, and also is often difficult to reach. So actually just serving a smaller ticket, cheaper insurance policy is not going to be the solution. You actually need to re-engineer the process of how insurance is delivered to them and also make sure that the product that's being delivered is really appropriate for their needs. So with this in mind, and the papers also go into this in some detail, I think proportionality is really key. And just to give some very concrete examples from a supervisory sort of perspective, when you're saying proportionate regulation and supervision, when it comes to licensing, I mean, the types of entities that these people might have interactions with are not the sort of the big agents, brokers, formal insurers. You actually need to have sort of maybe it's a funeral parlor, maybe it's a mutual cooperative, so another community-based organization. So these possibly need to be brought into the licensing sphere and allowed to serve insurance, because these are the ones who will actually have the relationships and the understanding of the risks of the consumers. I think distribution is a really key area here. And here you might well need to allow some untraditional sort of distribution channels. Your typical agents and brokers are also not going to have access or not going to be appealing even probably to these the low-income people. So they have good mobile sort of internet and internet connections and things now, so you need to think about whether insurance can maybe be delivered through some of these channels as well. I won't go into more detail, although I could, but I'd encourage you to look at A2I's website, and there's a lot of information about the different ways that we've seen supervisors thinking through and adapting, let's say, more proportionate approaches to their regulation and supervision. But it's a very difficult balance to strike, because it's not all about sort of, let's say, moving down or lowering some requirements. These consumers are also maybe not so familiar with financial products, and in some cases will need increased consumer protection. So there might be a need for some increased disclosures. And so you need to, carefully sort of strike the right balance. But I think another point that the papers make around this is you need to also allow innovation. So I think this is very difficult, sort of striking the balance between consumer protection on the one hand, but then also allowing and encouraging sort of insurers to come in and serve this sort of segment of the markets. But we have seen a lot of supervisors doing this. So going back to 2009, when the A2I was first established, there were only 6 different insurance supervisors and regulators who had developed supervisional frameworks, developed specifically aimed at low-income individuals. And since then, we actually count 53 different countries now who have developed inclusive insurance or often micro-insurance frameworks. So I think that's really impressive, and I think actually the key sources have been these IAS applications papers, like for the information.
Thank you very much, Anna. Liana, the COVID-19 pandemic has posed unprecedented challenges for financial stability in general, and in particular to insurers and other financial institutions. On the other hand, it has also fostered the development and adoption of new technologies through digitalization, which has benefited financial services consumers, in particularly through increased accessibility and availability. So what supervisory actions did HANFA take to support innovation and protect consumer interest at the same time?
Thank you, Suzette. So first of all, once again, lots have been said of this event, so I will not repeat, but just big thanks to everyone who could come in person. And so back to your question, Suzette, just even before COVID-19 broke out, we as a supervisory agency decided that we need to form an innovation hub. So we set up a platform. Why we did that? Because we know that the times are changing, and of course innovation is, I would say, even pivotal part of the future insurance. And on one hand side, then we wanted to enable to subtech, fintech companies, also the insurance who want to promote innovation on our market, to give kind of an informal advice even, if you wish, but also to help them steer, especially fintech and insurtech companies, to help them steer through sometimes really complex and abundant regulation. It's not always easy to go through that for them. Our insurance are already gotten used to that, but some other place on the market might not be just as used to that. And so we had an innovation hub. I need to say also that Croatian market is not big, it's quite traditional. We haven't had many inquiries. However, we do believe that in time this will simply rise as a topic, and we will have more and more inquiries via Innovation Hub. And related to what we did as also as supervisors to protect consumers within that area, we conducted mystery shopping. So we also set up our procedures and legal framework that enabled us to do so. Why we did that? Because we also think that whole digital era also shifts the paradigm of talking to clients as well. And so first what we did was doing an on-site mystery shopping, making sure and just wanted to check up on how customers and clients and consumers were talked to, whether they were offered what they needed, and whether they were provided with all the information they really need in order to buy or just reach an informative decision. And so going back forward, I think that we will put some thought also into mystery shopping, but when distribution is done digitally. So this is something we need also to reflect upon in the future. I think it's quite important. But also one last point I wanted to make is not just that we thought of, on one hand side, innovators, insurers, fintech, subtech, consumers, absolutely, because this is the central part. Anyhow, what we are all here, right? Consumers are the central part of our story, at least. But then also, what we did was also as an agency, we thought, a supervisory agency, we thought, okay, we need to also enable distributors to come to market and to get licensed to be able to do their exams and thus provide service to customers as well. And so since we were a bit challenged with, work from home or home offices, so that up till then we, of course, had physical exams for distributors. But then the whole team really did a great effort and made possible that we ultimately enable online exams for distributors, and thus also helping the consumers to get more players on the market, and of course to access insurance products more easy. So,
yeah, thank you very much. And before I pose the next question to Thomas, maybe we can get the results of the poll up so people can see what was the responses. So Thomas, the Financial Inclusion Forum under your lead is advancing this work by addressing supervisory practices and issues, in particularly on emerging trends and risks impacting financial inclusion. So in this regard, what are the key trends and risks identified by supervisors? Has the ongoing pandemic reshuffled the supervisory priorities, and what skills does the supervisor need to develop to tackle challenges to financial inclusion? Thanks, Thomas.
Thank you, Suzette. This is always a very interesting question. Of course, we are living in a very dynamic and complex environment. In the current landscape, climate risk, operational challenges from increased digitalizations and financial illiteracy are at the center of the discussions. And on your second point, I will say that the priorities have broadened, strengthening regulatory frameworks, as Hannah said, it's a very important issue, and improving supervision remains important. But these have to be pursued, keeping these trends on top of our heads. And in this changing environment, the supervisor needs to develop a holistic view and flexibility, as these are cross-cutting issues. It also needs to work closer with the stakeholders while keeping an ear close to consumers. And finally, in the era of social networks, enhance communication as this essential to increase literacy levels and inclusion. Maybe those are the main topics that in the fifth the members are giving for discussion and working together in order to look for some best practices and solutions. But I'm convinced that the role of the supervisory is key in this trend of making more inclusive marketing in our development countries. Thank you.
Yeah, thank you very much, Thomas. Just want to, did you answer the questions? Can we please have the results of the, there we go. Excellent. Shari, with the Sustainable Development Goals sitting at the top of the international development agenda, more focus has been on sustainable growth and building resilience. This is closely linked to the role of insurance, as protection of people and their assets is critical to more sustainable, resilient and inclusive development. In light of the challenges being discussed, why should financial inclusion be a point of concern for international organizations, and what is their role in increasing inclusion in insurance? Thanks, Sari.
Great, thank you so much. And again, thank you all for inviting you and Dessa to be here. And I'm so sorry that I'm sitting in New York and not with you today. So I want to start with the issue that inclusiveness is, well, first of all, the UN, just so you know, we are at the heart of, our job is in a sense to support the Sustainable Development Goals more broadly. And my particular office works on financing for development, which means that we support how does one finance and the SDGs, and what policies and frameworks need to be done, and what can governments can commit to make sure that we implement the SDGs. And financial inclusion has, from the very start of the SDGs, the Sustainable Development Goals in 2015, was actually a core part of thinking about how do we reach the poorest and make sure that we leave no one behind. And so if you look at the, there's a growing body of evidence that financial inclusion supports economic growth and employment and also reduces inequalities. And the 2030 Agenda, the Sustainable Development Goals, has a series of targets and indicators to reach the goals. And one of those is on financial inclusion, which also includes access to banking, insurance, and financial services for all. So this was from the very start in 2015, there was an acknowledgement that financial inclusion, including inclusion to insurance and other parts of financial markets, is part of supporting the SDGs. And then I would say that COVID-19 has really re-emphasized the need to accelerate financial inclusion, because access to financial services allowed workers that had access to better weather the crisis than others. And so it really underscored the importance of financial inclusion. Now, a lot of the studies that we've looked at have been based on access to more broadly financial services, including bank accounts as well as credit. And so there's been, I think, at least from our side, a little bit less work on insurance issues. Certainly COVID, though, has again underscored the importance of social protection, and again, the importance of insurance within that. And I would say that over the years, we've also periodically looked at some of the questions of how digital microinsurance, et cetera, has increased. And, looking at some of the trends, it doubled in 2017, but still the numbers from 2015 to 2017, I think that was the last year we had really good data. But some of the numbers were still quite low in terms of thinking about reaching the poorest. And one of the questions that came up when we did look at some of the data was something that was already mentioned on the panel, is what type of insurance are we talking about? And is it the most appropriate for the people and the consumers who are buying it? A lot of the insurance we were looking at was bundled in with other sort of inclusive packages. And there was a question of whether the people who are getting this access were actually getting the types of insurance that they really need the most. So to highlight 4 challenges really quickly, and then I'll go through some of the recommendations and ideas that are being discussed in the global discussions on implementing the SDGs more broadly, and particularly financial inclusion. So one, of course, is access. When you're talking about reaching the poor, and we're talking about the importance of digitalization in this, how does one actually reach the poor, especially since they don't all have digital access to digitalization? And also there are questions of gender gaps, et cetera. The other issue in particular with thinking about some of the insurance products is that in many cases, the poorest have the highest risks. And so yet they have the least affordability, and therefore they are not necessarily, in thinking about in terms of a profit, maximizing profits, they don't necessarily are not the customers that would necessarily would be the most attractive, given that they really do often have highest risks. Another issue that we'll talk about later today as well is consumer protection and literacy. And also one question that's come up in other areas, but and I know less about this, you in the room will know more about this than I do, how this translates to the insurance markets, is as digitalization and fintech has increased in other areas, there have been entities that are outside of the regulatory umbrella that are still intermediating credit or acting as financial intermediaries, but because they are new types of fintech companies, they don't always fall under the regulatory umbrella. And so one of the big challenges is how do we bring those new entities inside of the regulatory framework? At the same time as the SDGs were agreed to in 2015, there was also another agreement, the agreement that my office follows, which was called the Addis Ababa Action Agenda, which was on agreements governments made to implement and finance the SDGs. And so there were already a series of agreements made in 2015 relevant to financial inclusion. So I'll quickly go through some of those because it gets to the question of what the international community can do to support financial inclusion. And the first was on regulations. There was actually an agreement to consider including financial inclusion as a policy objective in financial regulations. And also agreements on making sure that the policy and regulatory frameworks support financial market stability, but also promote financial inclusion in a balanced manner, including with consumer protection. There was also, that's the first one on the regulatory framework. There was also an agreement to start implementing national financial inclusion strategies. And because there was evidence that countries that actually adopted these strategies reduced exclusion twice as fast as those that did not. And so by 2022, I think around 70 countries had implemented these strategies. And many countries were updating their strategies to adjust for fintech, because some of these, the ones implemented before 2015, did not necessarily look at fintech as closely. And so there are also questions as these are being revised to think about, are there ways to incorporate insurance more than has been done in the past? And so one of the agreements also in Addis was that the international community should support countries in their national financial inclusion strategies. Other agreements were the importance of peer learning, and then, of course, financial literacy, which we will talk about in a later session, along with the importance of consumer protection. And finally, this question of, in a sense, what's often called blended finance, but this question of when there are consumers who may be priced out of the market, are there roles for government to try to bring those consumers in, to work with the private sector to make it more attractive to reach the poorest, who, as I said before, have the highest risks and may be left behind. So that's just some initial thoughts to start the conversation. Thanks.
Thank you. Thank you very much. I'm sorry. So if I can just summarize from the responses in a very short way, it's clear that both the supervisors and the industry will need to think differently and creatively on all levels. I hope that summarizes everything adequately. So on the next round of questions, this section will focus on the role of financial education in increasing insurance penetration and closing the protection gap. So again, there's a polling question for the audience that's up there, and that is, what is the most important benefit of financial inclusion or education? For this round, got one question for each of the panelists, so I'll in turn give them a chance to respond. So the COVID-19 has allowed for increased innovation across all sectors in the economy, and in particular in the supply of financial services. So what is the role of financial education in allowing consumers to benefit from access to insurance facilitated by digitalization? So Anna, if I can start with you.
Sure, and I think I think financial education is absolutely key. I think consumers firstly need to know what their risks are, and then once they also know what the risks are, they're facing also the opportunity that insurance might provide to help protect them against some of the risks they face. And financial education is obviously key for making sure that is the case. And going back to the poll we had just before, I feel that's also the sentiment that was coming out of the room. There was a real recognition of the importance of financial education. And this is also actually, A2I has a tool called our Inclusive Insurance Innovation Lab, where we bring a multi-stakeholder country team together. And the topic for each of the labs is what can you do in your country to improve insurance penetration, to help the insurance market grow? And actually the second lab that we did, the key theme coming out of actually nearly all of the country teams was that we need to try and build consumer awareness in our country. That's the one thing we want to target. It wasn't let's produce necessarily a product or a new distribution channel or change something in regulation. What not all, but the majority of the teams all said is actually financial education is the thing we want to work on. And we saw, I think the Rwanda country team did an awareness raising campaign through radio, TV and university competition. Argentina were using social media for their awareness campaign. And India were actually using mobile caller tunes, which then also, I think, links with your point on digitalization, that actually digitalization does also provide an opportunity, I think, for financial education. And a new way to get the message out about insurance. However, it does require people to be digitally literate, which then is an additional part of financial education or education that's needed for people to be able to benefit from the insurance.
Thanks. Thank you, Anna. Ileana, your response?
I think that financial education is really the central part of consumer protection as such. Without financial literacy, you can't really protect consumers. Although, of course, all the stakeholders try and need to try and keep trying, but it's all our jobs, I'd say, to promote financial education and alongside of that, financial literacy. And how is this connected with then inclusiveness? Well, if as a consumer you don't understand the product, then you're faced with two options, obviously. First, you buy. But then if you buy and you don't know what you're buying, that means that most probably you will end up dissatisfied, disappointed, and frustrated. Which means that in second round, you probably will not buy again. So you are off the market then. And so if you decide not to buy because you don't understand, you obviously are not going to get protection, which you might need, and which you maybe even might pay. And so again, we are widening the protection gap once, or excluding certain groups of people from the insurance, whereas they might be insured and they might need the product. And if just by reaching certain level of financial literacy or getting to the education they need, they might decide really well for themselves and buy exactly what they need and be content with that. And so to bring it a bit step forward as well, a financial literacy in the end also helps demand for insurance products, in my opinion. And so that is why I really do feel that this is the central part of consumer protection as such.
Thank you very much. Thomas, your view on this question?
Thank you, Suzette. Maybe it's important to discuss what means frustration for a consumer. And frustration is the gap or the difference between the expectation of the product and the real offer that they receive. And in between, there are a lot of misunderstandings or a lot of problem of quantify from the market too. And financial literacy is essential to avoid this problem of market conduct. To arise many of the untitled benefits of digitalization will be really important too, because with this digitalization we are putting away some of the part of people that can give some advice to the consumer. So there is the other topic that is important to increase the literacy in insurance, of course. Financial education empowers the consumer to make informed decisions and supports consumer protection. This is a topic that with the fifth we had constructive exchanges on the role of the distribution channels, providing adequate information to the consumer about the products, what's covered, and particularly what the exclusions are. And in fact, to give a more affordable product to the consumers, it's important to have a more easy understanding products and that will be easy to buy, but of course easy to make the claims and to receive the compensations that are promised in the products. I think both insurers and supervisors need to listen to consumers. Through complaints, supervisors can identify quick links to be tackled through financial literacy. By engaging with the consumers, of course, insurers will be able to increase consumers and understanding of insurance products and offer need-based products is a key. I think many supervisors are working with other regulators and national authority to support financial education. The question is who is in charge of financial education? The government, the regulator, the market, and I think there is a responsibility of all the stakeholders, but of course the regulator must be very active in this topic, and through consumer education campaigns, financial inclusion strategies, or microinsurance and inclusive insurance regulation. I think the role the supervisor is very huge and important in these topics. Increasing literacy in our market will give us more consumer with the power of taking good decisions and of course avoiding the conduct problems in our markets. Thank you, Susan.
Thank you, Thomas. Sorry, your view on this topic?
Great, thank you. So, and I mean, first, I agree with everything that's been said. So financial literacy is really important, clearly, and is, in a sense, part of consumer protection as well. And also is probably the responsibility of the entire, there's not one entity's responsibility, but it's really everyone working together. I just want to add, maybe because our work is always to be thinking about everything that can go wrong. And so when you deal, in many cases, the customers, the level of, especially when you're trying to reach those who are excluded, the level of the need for literacy, for basic literacy, financial literacy, doesn't exist yet. And so when you start getting into more complicated products, the first question is, how does one reach them and start with basic financial literacy? Some of the recommendations that we've had in conversations have been, how does one put financial literacy into schools at a younger age? But to really start, because there's a lot of, before getting to insurance issues, there are other issues, really the basics of financial literacy questions that many customers don't have. And as I think Thomas said, the importance of making sure that using literacy, but also using education because if a product doesn't work, then consumers will not come back. So it's really important for the entire industry, for consumers to have the right financial literacy and to really understand what they're buying. And I would just say that in a sense, even though financial literacy is part of consumer protection, we also need to not think that it replaces other types of consumer protection. So it can't, when you're talking about products that get complicated, it can't replace other types of protection for consumers, including protection against outright fraud, of course, as well as, again, about promises that or misunderstanding of products. How do you ensure or try to help consumers to the other types of consumer protections that are necessary. So I just want to say that these complement each other. It can be part of it, but it doesn't replace other types of consumer protection.
Thank you, Sally. Before we move off this topic, maybe we can get the results of the polling question up. Yeah, so by vast majority, the consumers empowers the consumers to take informed decisions. Okay, that then brings us to the third round of discussions. And then for this section, we will consider opportunities and challenges of digitalization for financial inclusion, and sort of touched on it in the previous two rounds. Again, polling question, if we can get that up. So to what extent will digitalization affect inclusion in insurance? And for this round, I'm going to ask each of the panelists a different question in term, and sort of to mix things up, let me start with you, Ileana. So with the latest events, there has been increased concern and heightened cyber risk. So do you think this might also negatively impact financial inclusion? And what supervisory actions can be taken to mitigate the risk?
Yeah. Well, sure, it can. And when we're talking about cyber risks, most often we also refer to companies' undertakings who are under attacks. But also now, I think that we witnessed that a physical person, private people are also under attacks. So if they're digital, they might be attacked, and they get attacked. And so by sitting on a large, tremendous amount of data, and insurers do sit on a tremendous amount of data, not just financial data like other financial service providers, but also really, really sensitive personal data. And so that it's really of utmost importance that you protect those data, because why should someone know your health status? It's a private thing, right? Alongside with your finances, of course. And so in that respect, obviously, everyone needs to do their part in the game, which means basically that the insurance company, the insurance undertakings need to take care that they have robust IT security systems. And then also, this refers to supervisors as well. It's not like we are secluded from the market. That means that we also have a large set of data we need to take care of. Which basically means that we need also to be protected. And in doing so, of course, what we ask from insurers, we also ask from ourselves as supervisors. So we need to have robust IT security system and protection and walls up in order to protect all the data we have an access to. And so what we can do, for instance, I will just make an example. When we go to on-site supervision of an undertaking. Alongside, of course, obviously with the team of supervisors, we definitely ask then the colleagues from IT security team to join. Why is that so? Because we want them to see really at site, on site, how IT security in insurance undertakings is being treated. Whether they have set up procedures, whether they have certain loopholes or holes that need to be, just shut, whether there are certain weaknesses that may arise once we do our supervision, and in doing so, then we also can, impose different measures. And I think that ultimately we also, for instance, we asked certain undertakings to provide us with the results of penetration testing, right? Why is this so important? Because this is not just for us. I mean, we need to be aware of the fact that if they do pen test, it's not just to make supervisor happy, obviously. It's to, to protect your clients, ultimately. And so, of course, they're doing that, and this is something that also is embedded then now in the regular business. You need to do regular testing. What we can also do as supervisors, we do that for ourselves. For instance, HANFA undertook a penetration test for its own system, right? Because we are not, as I've said, secluded from the whole digital era, and of course, supervisors might get also certain issues with cyber attacks. And so to wrap it up, I definitely think that also we have a lot of legislative framework that has been drawn up in order to protect all the players on the market as so to be better in terms of protection against cyber risks. And so yes, we can do a lot. And we need to keep doing it. And it's not, one-off. You don't do once penetration testing and then you just said, oh, we're okay. Yeah, but the time is passing by. You need to do new stuff. You need to do it again. You need to do maybe some new patches. And so definitely this is, I would say, an ongoing work. But I think also all our topics are, it seems, that way.
Thank you. Thomas, if I can turn to you. So Financial Inclusion Forum members have identified limited access to distribution points as one of the main obstacles for inclusion in insurance. Can you provide us with details on how insurers have used digitalization to respond to this challenge, in particular context to COVID?
Sure. I wanted to share some of the idea from the exchanges in the field. One thing was clear is the pandemic pushed many insurers out of their comfort zone to implement tools that otherwise would still be on hold. I mean, there are a lot of possibilities to digitalization for digitalization in the chain value of insurers, but there was on hold, and COVID-19 pushed them to put it in practice. Many insurers across jurisdictions have already developed and embedded artificial intelligence and machine learning tools across their operations, and that is fascinating, while others are still in the early stage of use. Some examples include on claim management, the use of fraud detection tools to prioritize investigations, and imaging scanning technology to assess the extent of damaged vehicle damage. And some insurers also implemented chatbots, machine learning tools to process documents and understand customer behaviors to develop personalized content. And on the other hand, on the marketing and sales front, digital tools have been implemented to identify customer segments more open to cross-selling opportunities and optimize marketing expenses. Maybe another example is the use of wearable devices, such as smartwatches, to generate specialized health insurance quotes based on the data, and so on. And it is clear that there are many benefits and opportunities stemming from digitalization, but we also need to keep an eye out of the risks it might pose, especially for consumers and data protection. And that is summarizing the context of our discussion in the fifth. And I think it's a topic that will give us a lot of things to think about. Thank you.
Thank you, Thomas. Sorry, how will the increased digitalization in the insurance sector support the efforts towards the Sustainable Development Goals? And what aspects of digitalization yet to be seized can benefit both access to insurance and the Sustainable Development Goals? You're on mute.
Thanks so much. So the access to digitalization has offered enormous opportunities for achieving the SDGs more broadly, as well as has been already noted by the other panelists, as well as increased risks. And so you have both sides of that. And the first issue that we're all focusing on is thinking about just the access to digitalization itself. So financial inclusion has grown so successfully because of the increase in fintech, but still around, 3/4 of the world has access to mobile phones, which is the biggest access. But that, of course, means that 1/4 of the world doesn't, and only half the world has access to the internet, and there is an enormous gender gap as well. And so the first issue is to really support increased digitalization and access, because that's the basis for using digitalization for financial instruments. So without that, it doesn't work. And again, where we said we're thinking about leaving no one behind, so we're thinking about inclusion of how do you reach those that are that either 1/4 of the world without mobile phones, or even bigger, the half the world without access to the internet. A second aspect of how digitalization can help is certainly that risks can be better, more precisely estimated with insurance issues. So this could lower premiums for some, and also possibly lead to wider coverage as we have more information and uncertainty decreases. At the same time, there is, as I said earlier, risk of exclusion, leaving out the riskiest people, including either the riskiest people could be priced out, or risky events that need to, the riskiest events can be priced out as well. So there is this challenge of finding ways to target clients to best reconcile equity and efficiency considerations, and how does one do that? And then, of course, there are these risks of fraud, et cetera. But in general, the real issue is that digitalization, in terms of thinking about access in general, and how do you reach and how do you make financial sectors more inclusive, this is the biggest tool we've had and really had the most impact. And so it's really the biggest opportunity, and the question is how does we as an international community work to make sure that the positives come from this, and while monitoring the risks.
Thank you. And to you. So, I mean, innovation is also impacting the way that we supervise, and a lot of jurisdictions has implemented, is busy implementing or planning to implement their own subtech solutions. So what are some of the skills and measures supervisors need to develop to ensure consumer protection?
Yeah, subtech, I mean, has the potential to provide supervisors suddenly with an opportunity to be a lot more efficient and better use the data that they are collecting and really understand the situation of an insurance company at a point in time. However, I mean, presently in emerging markets and developing economies, I'd say the use of subtech is still at a relatively early stage. To get about an understanding of where things currently are, the A2I did a survey last year, actually with supervisors in Africa and also supervisors in Asia. I think 18 different supervisors responded. And although 70% of the supervisors were using some form of subtech, in most cases it was just used for automated data collection or AML, CFT compliance and data management. And actually not so many supervisory authorities yet were using it for prudential and market conduct supervision or complaints management. We also asked supervisors actually whether they felt the use of subtech was actually making their organizations more efficient and freeing up resources. And I found the response to this question quite interesting, because actually only 40% of supervisors said yes, they thought it was making their organizations more efficient, and actually 30% said no, and 30% said we're not sure yet. So I also take from that it is, I mean, in still relatively early stages, and also the jury's out, I think, a little bit still, as to how the subtech can be best used and most efficient, I think, within authorities. We also asked supervisors about some of the challenges with taking up RegTech and subtech solutions. And here, concerns around the cost of implementing the solutions, concerns about actually whether the insurers in their market were ready to provide data, which would then enable the supervisors to use the platform, as well as the internal culture within the organization, and whether they had the internal capacity and sort of the knowledge and the skills of supervisors. And A2I also then asked them about, well, what capacity building needs do you have then as a result of subtech increasingly being used in more? And here, it was certainly a desire for more peer exchange with other supervisory authorities to find out how they were using subtech. And there were we had a number of technical requests on things like data visualization and data usage, but we also had quite a few requests more around the process side, about how an organization should manage a process of digitalizing its processes. Also concerns about there are legacy systems in place, and again, the transition from this from the legacy system. So, as I say, I think subtech has a lot of potential, but I think still in the EMDE context, it is at a relatively early stage of adoption.
Thank you very much, Anna. Just to conclude this theme and this round, maybe we can also get the results of the survey. So again, the top one supports the inclusion of all underserved and vulnerable populations. It was, again, quite pertinent, the choice. All right, it now brings us to the last round of questions. And it deals with the Sustainable Development Goals. And so I'm going to ask one question that all four panelists would respond to. So in your views, in your different roles, what could the role be of insurance supervisors in contributing to Sustainable Development Goals? I mean, we've touched on it a bit in the other rounds. And how can supervisors monitor the outcomes? So, Sari, I'm going to start with you. Thanks.
Great, thanks. So, I mean, I think that this whole, the whole session really addressed, in a sense, looked at this question. And I think that many of the questions, from the supervisor point of view, though really the people in this room know these roles so much better than I do, because not being an expert in this particular area and looking at things more broadly. So, but from the broader perspective, it's questions of making sure, how does one address fraud? How does one address financial literacy? And how does one really help make sure that the right products are reaching the people who need them most? And, this question of how do you reach leave no one behind and reach the excluded is a question that supervisors certainly can't do on their own, and it's really going to take the entire international community and national agencies and regulations and governments working together to find ways, policies, regulation, work together and the industry to find ways to reach those that are outside of the system right now. So, but it's I think that I'm certainly learning a lot, and it's wonderful to hear the other panelists. So I'm going to pass the floor to them to hear their thoughts on this.
Thank you. Thanks, Holly. Hannah, your view?
Sure. So through, supporting greater resilience, helping people come back after financial shocks, insurance does play a key role in supporting the achievement of the Sustainable Development Goals. And I feel within this room, this is, probably quite a well-acknowledged fact. However, when we actually look at the Sustainable Development Goals themselves and we look through them for references to insurance, we see that out of the 17 Sustainable Development Goals, actually only one of them sort of includes a reference to insurance, I think SDG 8. And in that SDG, there's actually no targets sort of attached to that, to monitoring that sort of reference to insurance, which for me says that we still need to build greater awareness sort of outside of the insurance sector on the important role that insurance can play and does play, I think, in supporting sustainable development. And this brings me on to the role of the insurance supervisor. I think insurance supervisors are sort of advocates for the sector with good sort of access to policymakers, have, I guess, an advocating role here in speaking to their colleagues and talking about the important role of where sort of insurance fits in. I think within the sector as well, insurance supervisors can help bring the different stakeholders together and coordinate efforts and help the industry sort of develop a joint vision actually around the Sustainable Development Goals. And I think when it comes to conversations with policymakers, I think they can actually look at the different sort of initiatives that are underway, within the government and actually see directly, if it's on agriculture, if it's on climate, contribute directly to say this is where we feel insurance can come in here. And also, as I think touched on earlier in the panel, I think public-private partnerships, are key to sort of covering some of the risks, things like climate risk, which also with greater resilience in that area is a very clear contributor to the Sustainable Development Goals. So the role of the insurance supervisor in maybe bringing the private sector together with the public sector to actually facilitate the types of partnerships needed to provide this coverage. And then, the last point is around data and evidence. And I think here having greater sort of evidence and data on the contribution that the insurance sector makes is really critical. And it's quite a vicious cycle. So the less data that is available, the less information there is on the impact, the less information on the impact, the less people are aware of the impact, and then the less it's actually incorporated then into financial sector development policies and everything else. So I think to sort of stop the vicious cycle, we as an industry need to actually collect more data and also articulate it in the language of the Sustainable Development Goals, so other policymakers and others outside of the sector can really understand the contribution the insurance sector makes. And this is something actually the A2I has been thinking about, quite a bit, and also with our sort of relationship with supervisors, thinking about how can we help supervisors collect more of the data from their side, which would be useful to articulate how the industry is achieving the Sustainable Development Goals. A lot of you will have found a little sticker on your seat, I think, when you came back after the break. And we did develop, actually, for insurance supervisors, the key performance indicators, which included a pillar on the Sustainable Development Goals. And if you go onto our website, you can see it. And actually, under each of the Sustainable Development Goals, we include a number of key performance indicators that can be used, that can be then tracked, which should then, under each of the Sustainable Development Goals, give a better picture of what the sector is doing.
Thank you. And now, Thomas, your view?
Thank you. It's my belief that in achieving the SDGs, supervisors can make a meaningful contribution first by raising awareness at the national level. And this is particularly important for emerging and developing countries. Second, supervisors can act as a bridge builders between the industry, government, and other organizations to establish a strategic partnership for cooperation. That in pursuing these goals, that in line with SDG 17. And finally, and related to your last questions, supervisors can collect data on issues beyond prevention indicators that are related to SDGs as well, Anna said. Adequate collection and management of data is key to assess the results of implementation efforts and progress towards the SDGs. It can make the protection gap more visible and encourage supervisors and the industry to set up their comfort zone. In monitoring the outcomes, I would like to refer to the fourth pillar of the Key Performance Indicator Toolkit for insurance supervisors on sustainable development. This handbook was produced by a steering group of the Sub-Saharan African KPI reporting project together with A2II and is a great job. A few words of advice of this. SDG indicators need to be developed to reflect individual jurisdiction priorities, collect short as well as long-term financial inclusion data is important. Don't reinvent the wheel. Start by building on existing prudential and market conduct data, which only a few KPIs develop a broader reporting in the longer term. And that is important because that have a regulatory cost. And finally, I would also like to add that the industry association and developing robust corporate social responsibility protocols in the insurance sector also play a key role in advancing towards the SDGs and increasing financial literacy and inclusion. Suzette, back to you.
Thanks, Thomas. I think it's only fit to give the host the last answer on this panel. Ileana, your view?
Thank you. So I think that pretty much everything has been already touched upon by the colleagues, but I would also like just to emphasize a few more things. So just one piece of information, and it's a curiosity actually. In promoting sustainability and inclusion, of course, coming back to financial literacy, you need to reach people, right? And to be able to do so, even as a regulator or as a supervisor, you need to do your share. And so, since the COVID broke out, then of course we needed to go a bit more digital, or a lot more digital as a supervisor. And so, normally we would give our sessions in terms of financial literacy live, right? We would go on site, and then we would just organize an event. Not just us, but of course we have other stakeholders, the industry, the Ministry of Finance, the National Bank, and so forth. What that meant, that you could reach only the people who were able to come. So who had the means, the time, and who were physically present. And then after the pandemic, we said, okay, we cannot stop these activities. We need to reach people still, and we will do online sessions. And then we looked at our statistics, and so more than 60% of our efforts towards enhancing financial literacy was done online. And these events were really visited, which was something we were really happy about. So we will proceed in doing that as well. Why am I talking about this? Because this is also the role of supervisor, and this was the question, how we can help also promote in the end, sustainability, and if you wish, inclusiveness. This is also one way we do that. But also, Hannah has been mentioning, alongside, of course, with Thomas, data. I think that generally we lack quantitative data, or we just need to additionally work on getting those and crunching them. Because if we don't do that, then we can't make targeted decisions. So, for instance, in the Republic of Croatia, we issued our national development strategy. Of course, we want to be green, we want to go green, we want to support sustainability as such. But then, talking to policymakers, you need to provide certain information. Not just, we have protection gaps. Yeah, but which ones? How many people are excluded? So these are the things we need to simply get from the data and then make an analysis, and then we can all, as a community, regardless, be it supervisors and or industry as well and other stakeholders, then we can make targeted proposals as well. And this is also the way you can close close certain issues. Talking about that, I know that the insurers are overwhelmed with the requirements of collecting data, reporting. It's not just they need to report on this. They need to report a whole lot of issues and areas they're dealing with on the daily basis. But this is not an easy stuff, right? And so we want to make it work. Then I know it's burdensome for the industry, but trust me, it's burdensome for the regulators as well. Because you need to invest not just time, you need to invest human resources, and that goes on both sides, but you need to invest also financial resources. And then touching upon our technology we have at hand, of course we need to invest in that as well. And then obviously learning how to use it. So I think there's a lot of work ahead of us, and although we have charted a lot of territory with the legislation, there still remains a lot to be touched upon in front of us.
Yeah, agree, fully agree. Thank you very much. I just want to check on time. Carlos, can we go for? Okay, good. So this concludes the formal questioning on our panel today. So I'm happy to open the floor for any questions from the audience. There's a roaming mic. There is a few hands. Sorry, these lights are so sharp. I can't see everything. Yeah, there's a gentleman there in the middle. The mic's next to you.
Thank you. I'm Bill Marcoux, and I'm speaking to you today on behalf of the Insurance Development Forum. For those of you who do not know of the IDF, it was formed about 6 years ago. It's a partnership between the insurance sector, the UN, the World Bank, and a number of other public and private stakeholders. The IDF's main focus from its beginning has been focusing on the protection gap surrounding climate change, natural disaster. So this conversation today is very germane to it. The IDF has focused in part of its work very much on the role of government laws, regulations, policies in facilitating, enabling the efforts to close the protection gap, or in some instances acting as a hindrance to that. The IDF just published a paper last week in collaboration with the Geneva Association and with immense support from A2I, it must be said, focusing on this general topic. So it's an important one. It's great that it's on the agenda today. My question for the panel really is, and you've touched on it, you've talked around this, but be interested in maybe some further elaboration. What do you think the regulatory world, and obviously many hundreds of jurisdictions, so it's going to depend, do you think regulators really embrace this role of developing markets actually having more lives covered by insurance? Because we know from the research in the paper that indeed in a number of jurisdictions, regulators say, my job is financial supervision, market conduct supervision, somebody else's job to grow a market or cover these issues. So interested in just your assessment. Clearly many here and in the previous discussions have reflected an embrace of this goal, but what do you think it is? What do you think could be done to ensure that more regulators have that view? And I guess tied to that is the role of the AIS and what its agenda is in embracing this mandate. Thanks.
Yeah, thank you very much. So maybe I can ask Hannah and Thomas to answer, to give you a response, just from an emerging market and A2I perspective, and then Thomas as the chair of the Financial Inclusion Forum. So Anna, if you want to go first.
Sure. I think within the A2I's work, I mean, we've definitely seen supervisors, I'd say increasingly, taking an interest in developing their markets, along with protecting it and consumer protection, financial stability. I think as I mentioned right in my first comment about how supervisors were developing frameworks explicitly to support inclusive insurance in their jurisdiction, and going back to 2009, there were only 6 of them, whereas today we see 53 either developed or under development or implemented. So I think that in itself speaks for the energy that insurance supervisors are putting into trying to make their approach more inclusive. To the part of your question around, what can help and what makes a difference, I think the mandates of the supervisor is incredibly important here. And increasingly we have seen more supervisors, particularly, I'd say, in EMDE markets, having a market development mandate sort of explicitly given to them alongside their sort of financial stability, consumer protection. And in the markets that we see that sort of mandate given, we do then, as a result, see supervisors actually being a lot more proactive in their approach. But I think it's not just, actually, maybe to add a bit more, it's not just the regulation that we see that's been put in place, but it's also the supervisory sort of approach, supervisory acting, which kind of goes beyond or alongside, let's say, the regulation. And there it's also the sort of innovation hubs that we heard about earlier from Croatia that are sort of spinning up. And A2I has its innovation, our own Inclusive Insurance Innovation Lab, and the high number of applications we get from supervisors to be part of the Innovation Lab process also to me indicates the high interest in getting ideas and input on how to further sort of insurance market development.
Thank you. Thomas?
Thank you. No, and that is a really great question. Formally or traditionally, the supervisor has the mandate of soundness and stability of the financial system. But we must think more holistic. All those topics are impacting the stability of our market. If the supervisor is not involved in actions to develop the market will permanently will be very small without any impact in the economy, and maybe will be more vulnerable because they are not capable, do not have the capacity to spread the risk and managing the risk. Secondly, the mandate is more than solvency issues. Conduct market could put in great problems to any company if they are pushed for the clients and right now with the networks, the streaming and the way to the news is communicating to the people. It could give some problems or a great problem to a company that is not having a good conduct in the market and are abusing for the consumers. And thirdly, we must to be prospective. That means there are another risks in the environment, and if we are building a framework to supervising with a SBR approach, there are another risks that are not just the financial ones and the solvency ones, and that is conduct risks, and that is climate change, of course, that is totally linked with the protection gap that the countries have, and of course with the inclusiveness of the population. The most literacy, the most inclusiveness, the most strong market, and the better we can build a good conduct in our market, we will have a better environment to develop our markets. And last but not least, the supervisor in the development market are very complaining about these topics, and in the FIFA we have had a lot of discussion about those in order to share experience in order to be more proactive in all those topics. So if you ask me my opinion, I'm totally sure that is one of the most important focus right now for a supervisor, and more in the development markets. Thank you, Susan.
Thank you, Thomas. I saw another hand in the middle. Yeah, there.
Good afternoon, and thank you very much for this interesting discussion. My name is Cristiano De Vergori, and I work for a consulting firm in Brussels, public affairs consulting firm, and I focus on insurance regulation mainly. My question for the panel is, within this broader discussion regarding financial inclusion and insurance gaps, and linked to the topic, the broader topic of value for money of insurance products, I wanted to ask the panel's views regarding the impact that inducements might have on the protection gap in terms of consumers having the products that they need, the kind of insurance that they need when they are advised about it. And the reason why I'm also asking this is because inducements as a topic are receiving increased attention at the EU level as part of the broader agenda for value for money. So thank you very much.
Thank you. Ileana, do you want to take that?
Yeah, thank you for the question. It's a great one. And I wish I could have, straightforward, simple answer. But the thing is, you touched upon a subject that is really crucial for us. And again, it's the question of, customer protection and how it's going to be done in the future as well. So value for money is an ever-increasing subject, especially now when we see that more and more people invest also when they buy insurance products. And so if they do that, then of course they need to get something back. But in terms of they have certain expectations. So if you, for instance, place a product, you put it on the market and you say, all right, I will not offer you any guarantees. If we're talking about life, I'm not giving you guarantees, but you will invest a part of your assets to capital market. It might go up and down, so the risk is yours. If things turn out to be good, great. You'll get something in return, but that something in return doesn't necessarily be in return if you have charged or overcharged your client. And so we need to bear in mind that obviously also we as regulators and the industry is offering something which is of good value for client. Obviously everyone in this chain needs to get fed, right? On one hand side insurance companies and on the other hand side clients. But it's really important to keep that in a good balance. And of course, profitability is important, but it's also important that you don't have a client who is utterly dissatisfied and ultimately the one that couldn't get any benefit from the product. Then that means also that we as regulators didn't do what we needed to do and check upon these things. So yeah, great question. Just to one last point, to mention one last point related to that. Yes, this is definitely a very hot topic now, and I believe it'll get even more hot in the months to come.
Thank you very much. I think we've got time for one more question. If there are any further questions? No. Doesn't seem to be the case. I guess everybody wants to go for lunch. So on that note, may I thank my panelists for their time and for their inputs. Thomas, sorry, I do hope you get some sleep in during the course of today. May I also thank you all for your attention this morning, and I do hope that you found the panel and the discussions valuable today. So with that, I'll hand back to the MC. Mike, yours, sir.
Thank you, Suzette. That was an enlightening discussion and provided a real rallying call to action to make the global insurance sector more inclusive. And that also concludes our morning session.